Ladies and gentlemen, good morning. In honor of that flash crash we had in the Nasdaq on Friday, we will break with tradition and actually start with the Nasdaq so we can see what is going on. Our preferred viewing time frame is actually the 300-minute. And what we can see here is that all we have done is actually retrace to the 200 period moving average and bounced off it. We broke a very important level around the 58.13 area where we actually had a lot of trading, and once that happened there was a bit of a vacuum underneath all the way down to the 300-minute support area of the 200 period moving average. If we look at the daily chart of Nasdaq, we actually haven't even hit the lower Bollinger Band or the 50-day moving average support. That is still around the 5,600 area. So we still have another 150 points from the close on Friday to come down and test those levels. The oscillators have moved from a very high overbought level and are coming back down, which is healthy, and we therefore have an objective somewhere around the 5,600 level or slightly higher. You will have noticed that actually it was only the Nasdaq which was affected by the fall on Friday. S&Ps were almost unchanged. So since this is a relative move in the sectors, let us examine those first. This is a chart of XLK over XLF, and we see that what we have done is we have had a very sharp retracement which hasn't even caught the 200-day moving average. The 200-day moving average is still 1 or 2 percentage points below. This, we would argue, is a perfectly normal and healthy correction in the overbought situation in the FANG stocks. The 200-day moving average is turning, and we have a lot of price action around the 200-day level. So any move back down to the 200-day level we think will catch it and will be considerable support. We have support here, we will have support at the 200-day. If we look at XLK over XLI, we see the same kind of retracement, but if we put on some Fibonacci retracement levels, we see that we are only at the minimum retracement that we would expect. A 0.382 retracement would probably coincide in time with the 200 period moving average, 200-day moving average, which will be another 2 or 3% lower. All in all, this is a healthy retracement to a unsustainably fast move up in the ratio between XLK and XLI. So we have seen XLK, we've seen XLI, and now XLK over SPY, which is basically technology as a percentage of the overall index. You can see how steep the move has been in the past few weeks, and all we have done in that is come back to the minimum retracement level under Fibonacci, and we are more likely to come back down to at least this area around the 0.226. That might well coincide in time with this strongly upward sloping 200 period moving average. So we would argue that any retracement back towards these levels of the 50% is going to be a very good risk reward buy. Having seen the retracement levels in Nasdaq, the question then becomes, has there been any change in risk on, risk off behavior? This is SPY over TLT. And we see that last week there was absolutely no change in that behavior. So we have no indication of risk off. Therefore, all we can surmise is this was a sector specific move for technology, which was basically retracing a move which was unsustainably fast to the upside. And basically all they did is they took out people who were too long of FANG stocks, while the overall equity profile in terms of risk on and risk off is completely unchanged for the week. Finally, we'd like to look at one last indicator, which is SOX, i.e. the semiconductor index, which is a large part of the technology sector, over FXY, which is the yen. You would have thought if there was a risk-off move, people would move out of the most volatile sector of technology, which is semiconductors, and back into a defensive instrument like dollar yen. People would be buying the yen, getting out of the most volatile part of equities, and that we would have a very rapid change, deterioration in that index. Well, that's not the case. All we had on Friday was a very healthy retracement towards a 50-day moving average and a 200-day moving average, which are very violently upward sloping. So the argument would be that just like here, which happened in late April, you would have a move back down to test the 50-day moving average and then bounce back up. Going back to the daily chart of Nasdaq, what does that tell us are the most likely scenarios? Well, the most likely scenarios are that we are yet to complete the retracement of XLK relative to the other indices that we showed you, XLI, XLF, and SPY. Certainly the SOX index doesn't look like it has done all it's going to do against the yen. So we have a high probability short around the 58.10, 58.15 area, and a high probability long anywhere in between 5600 and this trend line, which we have held for a long time, which now comes in around 5,500, just over. So 5,600, 5,500 looks like a very high probability long for further moves up. Certainly if the spread indicators like XLK over SPY retrace to the 200-day moving average in red around the 50% retracement, that will tell us that it's time to go back into technology and that the move is going to be upwards from then on. If we look at a weekly chart of the TF, which is the Russell 2000, we actually see an upward break over the past week. As we expected, we have now tested this trend line and come back. Our best guess is that we will be slowly trending along it for the foreseeable future, for the next several months. So TF now should be a buy on all dips, especially anything to around 1380 is going to be a very high probability long for moves which we think will exhaust themselves somewhere around the 1460 to 1480 area within the next month or two. Certainly the summer should be a period of rallying for the Russell 2000 relative to most other contracts. If we were entering a period of risk off, you would expect that to be very much reflected in the transports. The transports are now rallying as well, so we think transports and the Russell 2000 are actually leading us higher, and therefore these moves in Nasdaq are purely corrective, purely money management, and purely what you would expect in a healthy market, which shakes out week longs before taking out the new highs. Certainly the trend has not changed. All we did in the transports is retest the 200-day moving average and bounce strongly off it. We are now off to new highs. This is all sector rotation out of very expensive technology stocks and back into far more stable stocks like the industrial sector and the transports. Well, going back to the fixed income market, we had a very uneventful week, which is what you would expect when you've got a 200-day moving average, which is sloping upwards, and a 38.2% retracement at the 213 yield. Certainly we didn't think that the market could go much lower in terms of yield, and we don't think it can go much higher either. We think that we are probably stuck under this trend line for the foreseeable future, unless the Federal Reserve next week does something unexpected, which we don't think they will, because they quite like the market being where it is. So we think that next week we'll be trading between 236 and 213, 20 basis point range, probably with a slight upward bias over the course of the week, but certainly not very much. This is the area that the market can actually repeat this kind of price action and remain in it for several weeks before the next move happens. And the only other chart of interest which actually echoes everything we've said about the 10-year, this is a chart of the 5-year against the DXY, the dollar index. You can actually observe the similarity of the pattern now in the Bollinger Bands. We bounced off the 96.50 level exactly to the tick. That has been there for months and months and months, and now we are probably going to test somewhere around the 98.5 level. The 200-day moving average in the Dixie is still rising, so still indicates that the chances are we will test that line from the downside. So we will have a rally towards the 99.5 area, and then we should be able to break back down with some momentum. So don't fight this move back up in the dollar. It is likely to stretch to at least 98.5, 99. That will be the area to put on some long-term options to the short side. For anyone thinking that the price action we had in the Nasdaq on Friday is actually the harbinger of a immediate move lower in equities, however small, the chart of gold is actually very instructive. We fell for 3 days straight, and actually the fall accelerated last Friday, on Friday, when the Nasdaq was crashing. That to us certainly implies that the Nasdaq move was absolutely a relative basis move, as opposed to an equity move, or it being a harbinger of anything at all. It will basically retest the 1260 area, which could be a good long, but certainly we would expect it now to work between 1250 and 1275 for several days before the market is ready, if at all, to make another move higher. Therefore, we just cannot get panicky about equities, while all the related markets like the yen and gold, all the risk-off markets, are behaving the way they are. So our biases for next week are actually very little changed. 5-year and 10-year, we think they're in the range with 0.38 true to retracement as the lower bound. We see very little upside in yields though, more likely to consolidate within a 10-15 basis point trading range than anything else. Bunds and bobbles absolutely dead for the time being, and we don't see why anything should happen there until the end of the summer when the ECB come back. We think that will be a very boring market. Commodity indices again are doing absolutely nothing. Therefore, the reflation that would short bonds aggressively is just not happening. There is no price action suggesting that it's even close. The equities, well, it'll all be in the sign of the Nasdaq. 58.10 to 40 is a high probability short, and a high probability long will be somewhere around the 5600 area, but only when the XLK against XLI, XLF and SPY levels have been met. If this is, as we are suggesting, sector rotation, you want not the Nasdaq outright to give you a buy signal, but you want these ratios to give you the buy signal. We will naturally tweet when we think that we are there, and we will be watching those sector rotations and levels like hawks. Russell 2000 should be your preferred sector now. It closed at new all-time highs as we suggested it would, so any dips in Russell 2000 are now outright buys, and certainly against other contracts. European equities, we still think it's buy a dip. EM, we still think it's buy a dip. And the dollar, as we showed you, we think it will now rally up towards the 99 area, where it becomes a high probability short. Thank you very much indeed, and speak to you next week.